What is the efficient frontier in portfolio optimization? Have you ever wondered how to build an investment portfolio that maximizes returns while managing risk? The concept of the efficient frontier is a key tool in portfolio optimization that can help you achieve this balance. So, what exactly is the efficient frontier? The efficient frontier represents a set of investment portfolios that offer the highest expected return for each level of risk. Risk is typically measured by the standard deviation of portfolio returns, which reflects how much those returns can vary. Portfolios that lie on this frontier are considered efficient because they provide the best possible return for the risk taken. When you are building an investment plan, the efficient frontier helps you find the best combinations of assets according to your risk tolerance. For instance, if you are willing to accept a moderate level of risk, the efficient frontier will show you the portfolio that should yield the highest return at that risk level. Visually, the efficient frontier is represented as a curve on a graph. The x-axis shows risk, while the y-axis displays expected return. Portfolios that fall below this curve are considered suboptimal because they yield lower returns for the same level of risk. On the other hand, portfolios above the curve do not exist, as they would imply better returns without taking on additional risk. One key aspect of the efficient frontier is diversification. The curve illustrates how combining different assets with varying correlations can reduce overall portfolio risk without sacrificing expected returns. This means you can achieve a portfolio on the efficient frontier by spreading your investments across different asset classes. Another important point is the risk-return trade-off. The efficient frontier embodies this trade-off, showing that as risk increases, expected returns also increase, but at a diminishing rate. This reflects the curve's shape, where higher risk does not always equate to proportionally higher returns. If you consider including risk-free assets, such as government bonds, the efficient frontier can be extended into a straight line known as the capital market line. This line starts at the risk-free return and is tangent to the efficient frontier of risky assets. It represents optimal portfolios that combine both risk-free and risky assets. The efficient frontier also serves as a guide for selecting portfolios that align with your individual risk tolerance and financial goals. This makes it a practical tool for making informed asset allocation decisions. Lastly, you can use the efficient frontier to benchmark your portfolio's performance. It helps you evaluate whether your current portfolio is efficient or if adjustments are necessary to improve returns for the risk you are taking. While the efficient frontier is a powerful framework, it does rely on certain assumptions. These include rational investor behavior, stable market conditions, and normally distributed returns, which may not always be the case. Nevertheless, it remains a foundational tool in portfolio management for adults looking to balance risk and return effectively.